Siddharth Purohit, Senior Equity Research Analyst Banking from Angel Broking is now joining us. Siddharth, what is your view on RBL Bank? Do you think it's a subscribe?
Yeah, we have given a subscribe recommendation on the issue. And if you tell me, why we like the banks, I can tell you a couple of points which really differentiates the bank compared to what other small size private banks are not doing. If you go back to the history of this bank, then this bank has been in existence for almost 7 decades now. But actually the true transformation for the bank started somewhere 6 years down the line when the new management led by Mr. Ahuja came on board, and then they started aggressively expanding the book. So from a loan book of less than 2,000 crore, now they have reached a loan book of almost 21,000 crore. And being just another bank now, they have tried to prove their own capability and has come to this level. Now this IPO will give them the much required funds for future growth. And just one point, what also we liked about this bank is that in last 4-5 years, when they have grown by almost 45% kind of CAGR, they have really not compromised on the asset quality. They have maintained their asset quality at a very comfortable level. If you look at their gross NPA level, it has been less than 1%. So I think when you are growing your balance sheet so aggressively and then you are able to contain your asset quality, it's really a commendable job. Given that every bank now, both the large private banks except HDFC Bank and PSU have been going through very tough times in the asset quality. So what we are believing is that possibly there is a growth opportunity for this bank left for many years ahead, and that too without compromising on the asset quality. So these all things should basically reflect and drill down to the bottom line growth. So, and if you look at the valuation also, I think at the issue price, I think on the diluted book of 106, it was offered at just 2.1 times book, which was really attractive to us. That's why we have a positive bias for this issue, and we have given a subscribe recommendation for this IPO.
Right. Don't you think the worry is that there is too much competition? It's very difficult to get CASA. They are giving rates which are much higher than what some of the other players in the industry are offering. So they are getting very, very aggressive, and the growth may continue, but however, at the cost of margins.
What will happen is that possibly you may not see substantial improvement in the margins, but one has to look at the fact that when they started expanding big way 5 years back, on a low base they might have higher CASA ratio as a percentage terms, but for the incremental growth without adding really aggressive branch expansion, they had to rely on the term deposits, and as a result your CASA ratio has come down. So now what the bank is also is trying to offer something better than their competitors to attract CASA. So, and one fact also one should understand that when they started aggressively, they were highly dependent on your large corporates for their lending operations. But as a the business matures, then they will possibly grow in other assets also, like retail also, which is just I think 15-17% of the loan book. There is enough scope for growing this segment. If you just compare to any other private banks, the large one, possibly ICICI or Axis, obviously we cannot compare with them, but they have almost 40-45% kind of their loan book coming from the retail, and this guy is only at 15-17%. So the scope I mean to say is that there is a place for growth in this retail which has a higher margins. Then if you talk about margins, then overall cost of fund for RBL has been on a higher side compared to any other, say, mid-size and small-size private banks. But as their branches matures and they possibly are able to really leverage on the brand name, which now they will get post-IPO also. So, and also branch expansion, I think their cost of fund also can come down, which will at least add something to the margins. Now, another point I would try to highlight here is that, the bank has aggressively spent a lot on the branch expansion, technology and manpower. So a lot of cost has been kind of front loaded in the last 3-4 years. So if you look at the cost to income ratio, it is close to 58% for the FY16 year end. I think it is on a very high side, and there is a scope for improvement in this. So my sense is that
let's
the bank is
Siddharth, let's just put that cost to income ratio into perspective. So it's at 58%. We look at the branch expansion of this bank and it is very muted. So why is there a scope to come down? Because they will expand more branches, they will expand more, and the cost to income ratio will only increase.
Yeah, I agree that they will add more branches, but one has to understand that that a lot of branches that they have opened is not necessarily on the very rural or semi-urban places. It has also been in the urban area and places like Bombay and Pune, where there is a lot of corporates available. So you may not see that incremental branch cost really going up very high, and possibly what will happen is that same kind of expenses may not happen in terms of manpower and technology what we saw. So while there will be branch expansion going ahead, but you may not have to spend so much on manpower, which already has been hired, and also the technology. So my point is that while they will keep on expanding the branches, it will not necessarily increase the cost to income ratio. It will rather kind of the maturing branches will start giving more business, and they have an option to, or maybe possibility of drilling down this cost to income ratio. That I think should play out in the bottom line front. And I see that their ROA of 0.9, just less than 1%, I think has enough scope because of this cost income ratio getting rationalized going ahead. So I feel that even if there is addition to branches, you may not see cost to income ratio going up from here. Rather, it will come down going ahead.
How would you look at the closest competitor? There are a lot of banks which are listed. With what would you compare it? Say a DCB bank, a mid-sized corporate bank, would you compare it with that?
See, here the difference of RBL compared to any other banks will be that the top management. The management led by Mr. Ahuja, the MD and CEO, has really had a very great set of career in the past MNC banks in Bank of America, and the people who are next to him are also equally capable, what I believe. And now they have also proven their kind of proved their expertise in the last 5 years by reporting this phenomenal growth. So what I am sensing is that they are in a verge of now growing for next. They are ready for next leg of growth. So while I'll not compare them with kind of Yes Bank or IndusInd Bank, but if you remember, IndusInd Bank, say a decade back, also had a lot of trouble where they were not really had a proper guidance where to grow. But once the new management led by the current MD came in, and then there has been rest has been history. They have really reported phenomenal growth. So while I'm not saying that exactly same set of numbers can be delivered by RBL or not, but there is a scope given the strength in the management. Now another point what I would like to highlight is that that the bank has really been expanding not in this area where it is perceived to be very risky, like in the project funding and all. They are present in the large corporate, mid corporate, where they are funding to this project working capital loans, and now they are talking about getting more into retail and other. So I think they should be compared. Better than this. They will not be compared to the old generation private sector banks, mostly the south based. They will get a better ranking or valuations compared to them, but a little lower than the new generation private sector bank. So I think from that point of view, I believe that it will be more of a bottom line growth, and we may not see sharp re-rating in terms of price to book value multiples immediately, but once the bank delivers and there is an improvement for ROE, I think they will be somewhere maybe close to this new generation private sector banks somewhere down the line. So I think I'll not compare them with this DCB and other banks, but I think the expertise that they have shown gives me confidence that they will be able to deliver much better numbers than their mid-sized private sector banks that have done in the last 4 or 5 years. Yes,
right. Let's talk about some other listed names as well. So a lot of NBFCs, a lot of wholesale funded banks have rallied since the RBI governor, had resigned and was expected to go, because the new governor that we would get, Street was expecting that there would be some huge rate cuts that would come in, very quick rate cuts. We've got the announcement of RBI governor now. And generally the view is that rate cuts may not be as fast as Street had started to expect. Do you think that's a negative for these wholesale funded NBFCs and banks, at least in the near term?
See, I'll not look at it from the change in RBI governance perspective, but what I would say is that if you observe in last 2-3 months number, the CPI inflation number has again started trending upward. And now when RBI is saying that that the next year inflation number, their target is 5%. Now we are almost at 6%. Almost above 6%. So now what the point is here is that despite a good monsoon, what we had a view earlier is that possibly post monsoon RBI will have an option of going for a further rate cut, and based on that your wholesale rates had started coming down. Even the GSEC 10-year GSEC yield had seen a sharp decline. But again now that inflation already has started spiking, so now I feel that the possibility of rate cut really it gets deferred. It's not that it will not go, the RBI will not go for a rate cut, but it might defer their plan for rate cut for a couple of more months before that inflation starts stabilizing and trending down. Because now that inflation is above the RBI's target range of 5%, I think the hope for rate cut would start coming down in the near term. While there is scope for rate cut for the entire financial year, maybe in next policy meet we may not see as we were expecting earlier. So it is little negative news for the large and wholesale funded banks and NBFC. But if you observe one thing, that a lot of NBFC have been able to raise funds through NCD at a much lower rate than what they were doing in last couple of quarters back. Just to give you an example of Dewan Housing Finance, where we had a buy rating. Now the bank has been able to borrow at a much lower rate than what they were doing for the entire FY16. So that gives comfort that there is enough liquidity in the market, and even RBI has been saying that they will bring down the liquidity to almost near neutral. So there is enough liquidity in the market. So even if rate cut doesn't really happen immediately, then banks or NBFC are able to borrow at a competitive rate. So I think it will, while it is negative from rate cuts point of view, but it will really not impact the profitability of a lot of NBFC and banks immediately.
Right, Siddharth, thank you so much for explaining us what's happening with these NBFCs and wholesale funded bank.